people with trillions of dollars of assets in 10 minutes can buy $10 million of Bitcoin, and they can do it no money down. So I could literally buy a $10 million house in 60 seconds with no cash, right? That's what happens when you get to an ETF. And so that will plug every major bank, every investment bank, all the money managers, all of the conventional Wall Street players into the asset class immediately.
Welcome back to Library of Wealth. Today we have Michael Saylor discussing the upcoming surge and price action for Bitcoin and the much-anticipated bull run very soon. Saylor's optimism is grounded in the upcoming halving event in April, as well as the approval of a Bitcoin spot ETF by the US Securities and Exchange Commission. The SEC is presently evaluating various applications, with its main proponent being BlackRock. With BlackRock's substantial influence, there is growing confidence that at least one spot Bitcoin ETF will receive approval in the very near future. This would be a monumental achievement for the Bitcoin community, something many have anticipated for over a decade. Securing approval would be transformative for the cryptocurrency world and would pave the way for substantial institutional investment, attracting sovereign wealth funds, major corporations, and even governments. Saylor believes this will also open the door for massive companies to hold cryptocurrencies on their balance sheets. Let's get right into the latest interview with Michael Saylor as he discusses how Bitcoin is a game changer in 2023 and what changes we can expect in crypto very soon. Don't forget to share your thoughts and comments down below and leave a like if you enjoy the content we do here. Let's get right into the video.
Let's say you're a hedge fund and you've got $1 billion under management. You've got an account with a big wirehouse like a JP Morgan or Morgan Stanley or Goldman Sachs. And you've currently got it invested in Apple or Google or Facebook or other securities or ETFs that trade on those systems. If you wanted to buy $10 million of Apple stock, you could pick up the phone and say, give me $10 million of Apple, put the phone down. And if you don't have the cash in your account, your banker will forward you the cash at SOFR plus 50 basis points. So you would pay 5% interest, and they would just go ahead and buy the $10 million of Apple stock. And then if you're short the cash, you're going to owe 5% interest on it over the course of the next year. But it's basically completely financed. Now, if you wanted to buy $10 million of an ETF like Bitcoin, and it's a spot ETF, you could do the same thing. You could say, buy me $10 million of Bitcoin ETF. They would front you the money, and you've got it in your account by the end of the day. Now, if you want to buy $10 million worth of Bitcoin, the asset, and you're that hedge fund, here's what happens today without the spot ETF. You have to go to your boss and say, I want to set up a new brokerage relationship with Coinbase. Then you have to get approval. Then you have to go to Coinbase. Then you have to get KYC'd. You have to wait 12 weeks. After the 12 weeks, if you've got it set up, then you've got to go to your board and you've got to change your trading mandate and get the permission to buy this. Then you've got to assign 3 people in finance to do the. Then you're got to establish a trading plan. And after you've done that, that takes like a year of bureaucratic moves, and they're going to say, now, wait a minute, we're going to establish, you have to modify the compensation system, the compliance system, the custody system.
I mean, I get it.
Okay. And they're going to say, why would you want to do this for 1% of your portfolio? And so let's say you did do it. If you took the year and if they agreed to rebuild all of their systems and rewire them so you could buy this Bitcoin, then you have to go back to your boss and say, oh, I need 10 million in cash. Because Coinbase can't advance you the money. So then after you go and you buy the Bitcoin, the 10 million in Bitcoin, then on the rest of your portfolio, the conventional Wall Street ETFs and stocks, you can borrow against them up to 50%. You can even, like against Apple stock, you could borrow 80% loan to value for nothing. But there's nobody that's going to give you a loan against the Bitcoin. So it's not collateral in the Wall Street system. It's the second system. So what I'm saying here is Bitcoin, the underlying asset, is impossible to finance, takes a year to buy, it requires an extreme amount of systems reconstruction, and it causes everyone that you work for to be worried. Like, they're all going to worry, well, what if you buy the Bitcoin and you wire it out to your own wallet, and what if you lose it? And so there's a lot of headaches. It's just not going to happen. And if it does happen, you can't borrow against it. But the spot Bitcoin ETF means I can have the same thing in one day for free. And then if it doubles or triples in value, I've got $30 million of Bitcoin. I can go borrow $15 million against the Bitcoin. I've already got the loan agreement. I've already got the best credit terms. I've got 50 basis point credit spread. So you see, one of these things is plugged into Wall Street. And the other thing is for the pioneers, right? The early adopters that want to take the arrows in their back. And the benefit you get by being an early adopter is you get in before it 10x's. Like, what'll happen is at some point, Bitcoin will be 250,000 and it'll be really easy to buy, and it'll be not scary, and it'll be easy to borrow against for it. And if you went to the trouble to get the crypto exchange account and to work through all those other things, you got to buy it for 10,000 or 5,000 or 15 or 20 or 30,000. Those will all look good.
The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Saylor asserts this journey is just beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Saylor highlights this being a significant development in the financial ecosystem. He also suggests that BlackRock, under the guidance of Larry Fink, will lead the charge in obtaining regulatory approval for a Bitcoin ETF. This move, he contends, will underscore Bitcoin's enduring relevance as an asset and its potential as a hedge against currency devaluation.
The accounting treatment for Bitcoin as of 4 years ago was indefinite intangible accounting. And that's the kind of accounting you would assign to assets that you didn't want people to buy, if I just boil it down, because it's the most conservative accounting you can imagine. Basically, you buy the asset and then you mark it down to the lowest price it's ever traded at in the history of the ownership of the asset. So if you bought Bitcoin and held it for 4 years, and at one point it had traded down 50%, then you're carrying it, at half of the amount you bought it for. And so you could buy $1 billion of Bitcoin. It could trade down 75%. Then it could trade back to par, and then it could increase by a factor of 10. So you have $10 billion. And your balance sheet would show you as having $250 million, even though you had $10 billion. So it would look like you had, 97.5% less than you have. And so as you can imagine, that's like a one-way ratchet function. If you're a CFO in a company like Facebook or Apple or Google, or any company where it was well received, where the stock was healthy, you would look at Bitcoin and say it's too volatile, and the volatility, you're afraid of it. It's not. I could guarantee you it's going to go up by a factor of 100. You still wouldn't buy it, because if it goes down by a factor of 3 before it goes up by a factor of 100,
it would
instead of showing $100 billion, you would be showing 300 million, and you would be way off. And so that's a problem. But the other problem with the old accounting was there's no distinction between an investment gain and an investment loss. I have a business that makes $1 billion a year, and I buy $2 billion of Bitcoin, and it trades down 50%. And so I have what looks like an operating loss of $1 billion against the $1 billion in operating profit. So it looks like I made nothing. And then when the Bitcoin trades back up again, you never get it back. The challenge for investors is you don't know how much money the company's got based on the GAAP accounting, but you also wouldn't really understand whether the core business was healthy or not healthy, because the volatility of the asset or the volatility of the accounting treatment would obscure the performance of the other business. And then the third problem is you could have $1 billion of Bitcoin a year ago, and it would look like you had 300 million. And this year you could have 10 billion, and it would look like you have 300 million. So in fact, you've actually generated $9 billion of capital return in the year, and it would look like you returned zero. And another company could actually have $1 billion, and it would look like they have 300 million. So it looks like your company has the same amount of Bitcoin as the other company, even though you have 10 times more than they have. So it makes it difficult to compare companies to each other, and it makes it difficult to compare periods to each other, and it makes it difficult to distinguish between an investment gain and an operating profit. So as you can imagine, you have to be pretty hardcore, or Bitcoin has to be your primary strategy, right? Like it has to be very, very important so that your investors will do the extra work to, instead of actually looking at something and in 30 seconds understanding exactly what happens. And if you have a simple business, in 5 seconds, I can say, oh yeah, they generated $300 million this quarter, or 30 cents a share. And it's like 5 seconds and you're done. So, under normal accounting, you would do that. But if you have this complicated, indefinite, intangible accounting, that 5-second analysis would become a 1 hour review or half-hour review. And so most people don't have the attention span. And so this change to the accounting provides transparency. So it's a big step forward for corporations.
Saylor challenges the conventional macroeconomic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures, which are selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Saylor also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly, and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Michael Saylor? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.